You see it all the time. A company posts record profits, but a year later, it's on the brink of collapse. How does that happen? Well, it's because the headline number, profit, isn't the whole story. Today, we're diving into a single metric that cuts through the noise and tells you what's really going on. And it's all about the cash.
Seriously, think about it. It just doesn't make sense on the surface, does it? A company is supposedly making more money than ever, the news is great, the stock is up, and then, boom, it all falls apart. The key to this whole puzzle is understanding that what a company reports as profit and the actual cash it has in the bank can be two very, very different things.
And this right here is the absolute heart of the matter. You need to think of reported earnings as, well, an opinion. It's a number that's been shaped and molded by complex accounting rules, estimates, and judgments. But cash flow? That's a fact. It's the cold, hard cash that's either in the company's bank account or it isn't. You just can't fake it.
So if we know that earnings can be a little fuzzy, where do we go to find the truth? Simple. We follow the money. And that leads us to probably the most powerful tool for seeing a company's true financial health, free cash flow.
The best way to think about free cash flow is to think about your own paycheck. You have your gross salary, right? But that's not what you actually get to spend. After taxes, insurance, all that stuff, the money that actually hits your bank account is your take-home pay. Well, free cash flow is a company's take-home pay. It's the cash that's left over after paying all the bills required to just keep the lights on and the machinery running. This is the good stuff they can use to really grow the business or reward shareholders.
Okay, so a company has, say, $1 billion in free cash flow. Is that good? Bad? I mean, for a huge company like Apple, it's one thing. For a smaller company, it's another. To make it a useful comparison tool, we have to turn that raw number into a percentage, a yield. So let's break down how we get there.
The starting point for everything is right here. Cash from operations. This is the raw cash that a company's main business pulls in. Selling widgets, providing services, whatever it is they do. This is the engine that drives the whole train.
But of course, you can't just pocket all that cash from the engine. A business has to reinvest some of it just to stay in the game. That's what we call capital expenditures, or CapEx for short. This is the money you spend on keeping your factories up to date, buying new computers, or upgrading your technology. It's a non-negotiable cost of doing business.
And really, it's that simple. You take all the cash your main business brings in, you subtract the essential cash you had to spend to maintain the business, and whatever is left over, that's your free cash flow. That's the prize.
Now for the last step, the part that makes this so powerful. We take that total free cash flow number and we divide it by the company's total value on the stock market. What you get is the free cash flow yield. It's a simple percentage that tells you exactly how much real cash the business is kicking off relative to what you'd pay to buy the whole thing.
All right, so we've done the math and we have our percentage. But a number without context is totally useless, right? So how do we read it? Let's build a quick mental framework, just like the pros use. This is the big question, isn't it? What's a good number? To figure that out, we need something to compare it to. We need a baseline. And the best baseline is always the safest investment you can possibly make.
So for our purposes, looking at 2025, that baseline is a 10-year U.S. Treasury bond. The yield is sitting around 4.5%. This is what's known as the risk-free rate of return. You're basically guaranteed to get this money back from the government.
And this brings us to the golden rule of investing. Buying a stock is always riskier than lending money to the U.S. government. A business can fail. So, to make that risk worth your while, you should demand a higher potential return, a higher yield, to compensate you for taking on that extra uncertainty.
So here's a pretty good rule of thumb. If you see a yield over 10%, that's usually very attractive. Something in the 7 to 10% range is still quite good. 4 to 7% is kind of market average for a decent, stable company. Now, if you see something under 3%, you have to ask why. Maybe it's a super fast-growing company, reinvesting every penny, which could be good, or it could just be an overvalued stock. And a negative yield, that's a huge red flag. It means the company is literally burning through cash just to operate.
But, and this is a huge but, you can't just blindly buy the stocks with the highest yield. Sometimes a super high yield isn't a sign of a great deal. It's a warning siren. It's what analysts call a value trap, and learning to spot one is absolutely critical.
A value trap looks like a bargain. It really does. The yield is high, the stock looks cheap. But what's really happening is that the company is in a nosedive. The yield only looks high because the stock price, the denominator in our equation, has collapsed. It's a warning, not an opportunity.
So how do we stay out of these traps? Well, you look for the telltale signs. Are revenues falling year after year? Is the company buried under a mountain of debt? And here's a really subtle one that pros look for. Is the company spending less on CapEx than its assets are depreciating? That's a fancy way of saying they aren't even investing enough to maintain what they already have. They are slowly, quietly liquidating the business.
Now, to make things even more complicated, there's a modern accounting rule you have to know about. It's called IFRS 16, and if you're not careful, it can create a huge blind spot. It can make a company's free cash flow look way better than it actually is.
Okay, here's how this trap works in simple terms. In the old days, if a company rented a building, that whole rent payment came out of their cash from operations. Simple. But under the new rule, part of that payment, the principal portion, gets moved down to a totally different section called financing cash flow. The result? Cash from operations looks artificially bigger, which makes free cash flow look bigger, which makes the yield look better. A smart analyst knows they have to go in and manually adjust for this to get the real picture.
All right, enough with the theory. This stuff really comes to life when you see it in the real world. So let's look at a case study where this exact kind of cash flow analysis uncovered a massive industry-wide transformation. We're going to talk about the gold mining industry. For decades, these companies were notorious for just burning through cash. They'd spend a fortune digging gold out of the ground and barely make any real money. But then, around 2025, something incredible happened. A perfect storm of record-high gold prices and years of disciplined spending created a full-blown financial revolution.
And just look at this shift. It's absolutely staggering. For years and years, the free cash flow margin for gold miners was basically zero. They spent every single dollar they brought in. But by 2025, that margin exploded to 30%. All of a sudden, these companies weren't just cash burners, they became some of the most powerful cash-generating machines on the planet.
I think this quote just perfectly sums up everything we've talked about. At the end of the day, earnings can be an illusion. They can fluctuate. But the actual cash a business generates, that is the only thing that can ultimately pay dividends, buy back stock, and create real long-term value for you as an investor. It's the bottom line.
So I'll leave you with this. The next time you're reading the news and you see a big flashy headline about a company's record profits, you'll know better. You'll be one of the few who can look past the noise and ask the only question that truly matters. That's great, but show me the cash.